Let's jump right into Landmark REIT's Q1 2026 financial results. Today, we're unpacking a really fascinating case study in this explainer, one where a strong operational recovery is basically colliding head-on with some brutal macroeconomic realities. If you follow Southeast Asian real estate, the tension in this quarter's numbers is literally a masterclass in market dynamics. It perfectly illustrates how what happens on the ground inside a bustling shopping mall doesn't always translate cleanly to the bottom line.
Right. So we're looking at a pretty wild contradiction here. How on earth can a REIT with strong operational metrics, packed malls, and growing revenue just suddenly halt all distributions to its investors? It sounds totally counterintuitive, doesn't it? You'd normally think, hey, strong mall traffic equals a nice quarterly payout. But as we're going to see in the data, the reality of cross-border real estate investing is a whole lot messier than that.
But before we get deep into the numbers, let's establish exactly who we're looking at today. Meet Landmark REIT and their new identity. So, Landmark REIT just rebranded in March 2026. You might actually know them by their old name, Lippo Mall's Indonesia Retail Trust. But even with the new name, at its core, this trust remains a massive player in Southeast Asia's largest economy. We are talking about a huge retail footprint here, 29 properties valued at roughly 18.6 trillion rupiah. These malls are spread across major Indonesian cities, directly serving a rapidly growing middle class that is super eager to spend money on familiar brands like Zara, Uniqlo, and Starbucks. Now, what's really interesting is their new mandate. They didn't just slap a new logo on the door. They are executing a major strategic pivot. They're actively expanding beyond just Indonesian retail to a diversified, multi-asset, and multi-geography approach across Asia. Basically, they're signaling to the market that while Indonesia is their foundation, their future might look a lot more like integrated mixed-use spaces or totally different asset classes across the broader Asian region. It's a bold move to outgrow those current geographic limits. All right, let's dive into the Q1 2026 financial highlights, starting with the merits. Let's look at the bull side of our ledger first, because honestly, on the ground, things are looking remarkably strong. When you look at the underlying performance in local Indonesian rupiah, it is incredibly robust. Gross revenue shot up 14.3%, and net property income grew an impressive 15.6% to over 406 billion rupiah. Management attributes this to higher rental revenue from better occupancy, plus a massive jump in car park income. That car park revenue actually surged nearly 30% thanks to a new management setup and, well, visibly higher shopper traffic. So operationally, this is a huge win for the team. But, and here is the catch. When you translate those rupiah back into Singapore dollars, that 15.6% net property income growth suddenly shrinks down to just 5.7%, hitting 30.8 million Singapore dollars for the quarter. You can literally see the friction happening in real time. Currency exposure is basically this silent tax on cross-border REITs. The malls are generating tons of cash locally, but because the rupiah weakened against the Singapore dollar, a huge chunk of those gains just vanishes into thin air before it ever reaches the Singapore-listed holding company. Let's look at what's driving those local gains with portfolio and occupancy strength. The absolute standout point here is how much Landmark REIT is outperforming the broader market. They're sitting on a stellar 87.5% occupancy rate. Compare that to the industry average of just 78.4%. That is a massive gap, and it doesn't happen by accident. Management has been pretty ruthless about swapping out underperforming tenants and doing targeted upgrades to keep these malls feeling fresh, busy, and attractive to premium brands. And here's the real kicker. This isn't just a case of one or two flagship megamalls carrying the dead weight of the rest of the portfolio. Nearly 70% of their 29 properties are operating at over 85% capacity. That shows a really broad-based structural recovery across their entire Indonesian footprint. People are returning to malls in droves, and retailers are scrambling to sign leases to meet them. Beyond the day-to-day mall operations, management has also been busy cleaning up the balance sheet. So let's talk capital management and debt. Early in 2026, they made some major moves to de-risk. First up, in January, they successfully raised 63 million Singapore dollars through a rights issue. Then, they turned right around in February and used those exact proceeds to completely wipe out their outstanding 22.6 million US dollar notes. By knocking out that immediate maturity hurdle, they essentially bought themselves some vital breathing room in what is, let's face it, a pretty unforgiving global interest rate environment right now. This disciplined capital management successfully dragged their aggregate leverage, their gearing ratio, down to a much healthier 40.22%. That's a highly meaningful improvement. It fortifies the balance sheet, creates a nice buffer against any potential asset devaluations, and just gives them a lot more financial flexibility going forward.
Okay, so revenues are up locally, malls are packed, debt is down. So why is there a bear case at all? What's causing that tension we talked about at the beginning? That brings us to their weaknesses and ongoing risks. Well, here's the elephant in the room. Despite this fantastic operational comeback, the REIT is caught in a severe liquidity pinch. Current liabilities are actually outweighing current assets by 45.1 million Singapore dollars. Now, to be fair, a big chunk of those liabilities, about 58.5 million, are advance payments from tenants that are contractually non-refundable. But even when you factor that in, their cash flow is incredibly tight. It's so tight, in fact, that the manager has explicitly called out liquidity as an ongoing risk to their capital structure.
On top of that, the trust is just getting battered by macro headwinds. The biggest blow, an 8.5% depreciation of the rupiah against the Singapore dollar over the year. Like we saw earlier, that completely dilutes their actual earnings. Throw in global inflation and the Bank of Indonesia stubbornly holding benchmark rates at 4.75% to protect their currency from geopolitical shocks, and you've got a perfect storm of external pressures squeezing the trust. And this is what leads to the ultimate gut punch for income-seeking investors. As the CEO, James Liu, stated, to conserve cash and meet their strict loan obligations, all distributions remain halted. This triggers what's called a dividend stopper provision. Because the REIT had to pause payouts on its perpetual securities just to save cash, it is now legally blocked from paying a single dime in dividends to standard unit holders. They literally cannot afford to distribute cash while they're scrambling to prioritize debt repayment and basic survival. So, balancing these really strong operational merits against some pretty stark financial realities, looking ahead, what's the game plan? Management is basically leaning on three key pillars to survive this. Number one, staying hyper-disciplined with capital. We're talking about conserving every possible dollar until the overarching financial picture improves. Number two, relentlessly optimizing their existing malls so they don't lose that stellar 87.5% occupancy rate. And number three, gradually rolling out that new multi-asset strategy so they aren't entirely at the mercy of one country's retail sector and currency swings forever. So, as the macroeconomic dust eventually settles, the million-dollar question remains. Can this massive strategic pivot actually translate robust, on-the-ground mall operations into real distributable cash for you, the investor? I mean, they've fixed the malls, they've paid down immediate debt, but bridging that huge gap between local retail success and Singapore dollar payouts is the ultimate test. Will expanding across Asia be the key that finally unlocks that trapped value? It is a deeply complex ledger, but definitely one you're going to want to keep a close eye on.